Good morning and welcome to this Thursday, August 3rd, 2023 edition of Trading Places Live with or at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and we'll go through what's happening in the market over the next 30 minutes or so and get ready for today's trading action. Yesterday, interesting day. I know a lot was blamed on the Fitch downgrade. The market did sell off pretty hard. Some key areas that we've grown accustomed to leading the market to the upside actually led the market to the downside, but profit taking is a part of what's going on. We saw the market rotate a little bit into the defensive area, and I know that's probably a question that many of you have, because when defensive stocks lead, that tends to be a problem for the market. However, I'll just say that defensive stocks almost always lead when the market pulls back. That's not really what I'm concerned about. What I'm concerned about is when the market is going higher and money begins to rotate, because that's unusual. But we do have short-term issues in the market. We've been talking about the divergences. We had the VIX breakout of a downtrend yesterday, actually got up into the 16s to around 17. That was an area that I thought, the first time we had some selling, we'd probably hit that area. I think the bigger level from a longer term perspective, or maybe from an intermediate term perspective, would be around the 20 level. That's where we've had a lot of failures. We'll look at that chart in just a little bit. But I do want to welcome you. We have, let me take a quick look at futures. It does look like we're going to extend some selling at the open. Dow futures down 56. S&P 500 futures down 13, Nasdaq futures down about 78. Crude oil prices up about 29 cents a barrel. That takes us back up close to $80 a barrel. We did see a down day yesterday on crude oil. And the U.S. 10-year Treasury yield, and this is what I think short-term could give us some problems. The 10-year Treasury yield is at 4.17%. That is up 9 basis points this morning, and not far from the high that we saw in October of 2022, which I believe was around 4.32, 4.33%. So we're getting closer there. But the key here with the 10-year Treasury yield, and again, I'll show you a chart on this just a couple minutes, it was a breakout above a double top that we saw at 4.10%. So this breakout, if it sticks, and of course, tomorrow morning, we've got the non-farm payrolls. That could have a big impact on both the bond and the stock market. So that's going to be something to watch. And later today, after the bell, it's Apple, it's Amazon. Both of them come out with earnings. So volatility could be extreme. We could see a significant rally back, or we could see a more significant breakdown in the market based on just those couple of things alone. Apple earnings, Amazon earnings, and then the non-farm payrolls in the morning. So we just take what we get. I think caution remains in the air. I sent out a DMR to our members yesterday, said I got much, much more defensive. And for me, it was more about the rising interest rates and the VIX, and the fact that as the market was going down, we saw some of my key ratios going down with it, which just tells us that it could have more sustainability to the downside. If we were breaking down and I had my relative ratios moving up, probably would have been doubling down on some things, maybe even getting into leverage. And I'm looking at that now, to be quite honest. But for the very, very short term, and I'm just talking about for the next day or two, I thought it made sense to just kind of move to the sidelines and wait and see how we open today, how we trade, what's the relative ratios, what do they look like? So a lot of that going on. Anyway, kind of a long intro, but let's go ahead and take a look at what happened yesterday. All right, so we had the Dow Jones Industrial Average down 348 points. That was about 1%. S&P 500 down 63. That was almost 1.4%. The Nasdaq 100 down 347 points, which was down 2.2%. Mid caps down 30. That was 1.1%. Small caps down 11, but that was just under 0.9%. So one of the things that I've been talking about a lot with members, and I've been talking about a little bit on the shows as well, is that a lot of times we're seeing these big gap downs, which is a little reminiscent of what we saw in 2022, even into early 2023. But after the opening bell, what we're seeing is rotation into the small caps and away from some of the other areas of the market. And I find that somewhat fascinating, but intriguing, because I think small caps could lead the next leg of the market to the upside. And so seeing that rotation right now kind of lends itself to that belief. We'll see. I'm just pointing out what I'm seeing. Last couple of days, we've seen gap downs. And really over the last couple of weeks, if you look, a lot of times small caps relative to the QQQ, so the IWM versus the QQQ, we're seeing that ratio go up in the afternoons, telling me that money is moving more into that area. So this could be a precursor to a very significant move to the upside in small caps. That's one of the things I'll be watching for. Transports down 150 points. They were down less than 1%. So this is a group that's been on fire really over the last 2 months or so. And you'd think, hey, we get a big sell-off, this is the group that would probably lead to the downside, but it didn't. It was actually one of the better relative performers. So transports continue to be very strong, in my opinion. XLP, Staples, that was your best performing group yesterday. Healthcare was your next best group, just a little bit above the flat line. And then utilities were third. They were flat. Everything else down. So we were seeing that rotation into defensive stocks. But again, that's normal when you're selling off. If you look at any time in history, when you get sell-offs, it's just normal for money to go on a relative basis towards those areas. So I'm not reading too much into that. Again, what I would be more concerned about was the market taking back off, setting new highs, and being led by these three groups. When you're being led by defensive groups, that tells you you're probably not on very strong footing. And so that is what I would be looking for. Don't, I say this all the time, but don't get confused when defensive stocks lead when the market goes down, because it happens all the time. That's not unusual. Moving on to the industry groups, though, look at what was struggling yesterday. And hey, like I said, number one, it's okay to have profit taking. Number two, these groups have been rough in terms of their divergences. The momentum has been slowing in these groups. And when that happens, many times that's followed by some very quick sell-offs. So semiconductors yesterday, down 4%, down 440 points. We were well up over 10,000. Now we're back down to into the 9,900s, just a little bit below 10,000. But more importantly to me is we've lost the 20-day moving average. The 20-day moving average was 10,034.95. We closed at 99.65.84. And if you look back, that was the first time in about 2.5, 3 months that the semiconductors have actually closed a trading day below the 20-day moving average. That, combined with the volume that came in on some of that selling, which you can see at the bottom here, and along with negative divergences, that just tells me that there is a very strong likelihood, not a guarantee, but a strong likelihood that we're going to go get that 50-day test. And 50-day is right now at 95.89. That's another 4% below on the semiconductors. Look at software, higher highs, lower PPOs, negative divergence. Here we actually got the 50-day test. Not only a 50-day test, but if you look, we closed just slightly beneath the 50-day. So there could be a little panic setting in some of the software stocks here over the next day or couple of days. Now, maybe we just have a little bit of downside, get below the 50, and then based on the jobs report, Apple and Amazon, maybe tech, software included, moves back to the upside and takes off again. I don't know. But I think today, in anticipation of it, especially with the VIX up, futures down again. Actually, I'm looking Nasdaq futures now down over 100, around 100. That could trigger more volatility. It could produce what I like to call market makers on vacation. And the analogy I would use is a matador in a bullfight, with the yellow cloth, or red cloth, letting the bulls go. I mean, this is kind of what the market does when the volatility starts to spike and the supply overwhelms demand. Market makers, rather than committing their capital, which is limited, by the way, they don't have unlimited capital. When they see it coming, they just kind of step to the side and let the market kind of figure it out. And unfortunately, when you have so many sellers and not enough buyers, you see swift moves to the downside. Selling is almost always more swift than buying. Market gets pretty boring when it gets into a bull market and starts going higher. Doesn't usually jump by hundreds and hundreds of points. It's usually 50 here, 75 there, maybe we go up 110, pull back 20, and then we're back up 60, 70. That's the way a bull market is. Very boring. VIX goes down 9, 10. But in a sell-off, when things start to turn more bearish in the near term, things tend to come down a lot faster. And some of the stocks with earnings, I mean, it's been amazing. Companies that are beating top line, beating bottom line, and just getting massacred after earnings. Once again, buy on the rumor heading into earnings season, sell on the news. That's the history of the stock market. Probably not going to change anytime soon. But looking at the semiconductor software, not looking good there. And then internet stocks, still a slight, actually, I don't even know if I would call this a negative divergence. By definition, yes, we have higher prices and we have lower PPO. But what I look for with divergences is a reset of the momentum, because once the PPO goes to the zero line, there's no momentum issue. Your short-term and your long-term moving average are exactly the same. So as far as I'm concerned, you have reset. It's like, I like to use the analogy of a baseball game. You have a 3-game series. Friday night, you got 2 teams playing. Somebody wins 10-2. When they come out Saturday, they don't start 10-2. That game's over. Now you're back to 0-0. What's going to happen in this game? We don't know. That's kind of what the PPO tells me. We have a negative divergence. We get that back to the center line or close to the center line, get a 50-day test. At that point, the game starts over. It's 0-0 again. Bulls aren't winning. Bears aren't winning. Momentum is squarely on that center line. It's 0. So, when you have the negative divergence, you look for the short-term weakness, but once you get it and it's like, okay, maybe this is a major top and we do break down, but a lot of times it's just a test, reset of the PPO, and right back off we go to the upside. So too early to tell what this looks like, how much additional precaution you might need to take. I'm not seeing this as a long-term issue at all. Zero worry at this point based on a couple days selling. But in the short term, yeah, we could see more selling. So we've got to be careful. 10-year Treasury yield. Okay, so here is the update. We had seen the tops in early March and again in early July at 410. Both these highs were at 410. Back here in October of last year, we were at 433. And remember, that move up to 433 is what triggered the bottom, the final leg of the cyclical bear market. So it stands to reason that when the yields break out, we need to at least be concerned. Again, long term, am I worried about 4.17%? No. Historically, I think if rates are rising and you're going back above about 5%, that starts to get a little, nerve-wracking. So I think there's still a little bit of room to the upside without squashing this bull market. But the short term, I mean, we're not going to go up every day. And this is a news story. We have yields going up. We have a jobs report tomorrow. The market likes to play off of some of these news stories. There's a lot of manipulation in the market. I've pointed out plenty of it over the last few years. Not going to get into that again today, but it happens. And so you're going to get pullbacks from time to time. Market's not going to go up all the time. Short term, we've got some issues. Long term, I see none at this point. Moving on to the S&P 500. Just looking at what's going on. So the 20-day moving average was 45.16. We closed at 45.13. Closed below that 20-day for the first time since back at the end of May. And we did it with a slight negative divergence. I mean, there's no question it's a negative divergence. No matter how you slice it, you can look at these highs right there. You can go back to these highs and you're still lower, but it's a slight negative divergence. It wouldn't take a lot of strength for the PPO to turn up and eliminate the negative divergence. The NDX a little bit different. We'll take a look at that in just a second. But also, as we were going higher, one of the things while we were going lower in 2022, I kept talking about the AD line. AD line's going up. AD line's going up. That's a good sign, good for the market. Well, got to play both sides of the coin. Right now, the market's going up. Look what's happened over the last couple of weeks. Now, this has come in since the Tuesday of options expiration week. And that's about the time we started to see breakouts with negative divergences. And so it was right around the middle of July. I said, hey, we got to be cautious here. I know my last Your Daily 5 that I did over at Stock Charts was much, much more bearish than anything I'd done in a long time. And it wasn't long-term bearish. It was just, we need to be cautious in the near term. And I think that's what we're still battling right here. I think there's a decent chance that we're going to hit the 50-day at some point in August, maybe in September, but I think it could happen in August. This is actually the best time period in August right now, what we're in. We have a little bit of a bullish period from the 11th to the 18th, but the first 3 days of August tend to be pretty bullish, and we're seeing nothing but down action right now. Now, again, I don't trade based on seasonality, but I do use it as an indicator, just like I use PPI or PPO, AD lines, relative strength, all those things are secondary, although relative strength is a pretty big one. But now we're starting to see some of the selling that we had talked about here over the last couple of weeks, because need to be a little cautious. Nothing really has changed that much. Still have the negative divergences. Looking at the NDX, here is where we have a little bit more problem, because they're more heavily weighted. This index is more heavily weighted in the semiconductors, the software, the internet, automobiles, and they're not weighted in areas, a lot of the value areas where we're seeing money rotate to. I would ask you to try and go find some utilities in Nasdaq 100, consumer staples. These are areas that really are not represented much at all, if at all, in the Nasdaq 100. So when you're starting to see bigger sell-offs in some of the key areas, key aggressive growth areas, obviously it's going to impact the Nasdaq 100 harder. And we're seeing that. It was a more definitive breakdown of the 20-day. 20-day is at 15,448, and we finished at 15,370. So we're talking about 70 or 80 points below. And it was the first time, really, this is the biggest breakdown below the 20-day since late April, which, by the way, was kind of like toward the end of the majority of earnings in April. So you tend to see weakness coming in as you start to get through a lot of these earnings reports. So again, back to the 50-day, is it possible? Absolutely. Look at any bull market. 50-day tests are kind of normal, and we might even go a little bit below. If we go below, I'll be cautious until we come back up above, because you don't want to be overly aggressive if you're breaking down below some key moving averages. So short term in that instance would outweigh what I believe is long term until we see that move back up and start to right the ship again. So there are times when you want to be more cautious than others. I think right now, breaking down below the 20 days, moving averages on our key indices, I think that's time to at least be thinking about checking out of some of these stocks temporarily. I want to stress that, temporarily. I'm a short-term momentum trader, and if I think that the risks are higher, that we're going to go down for the next couple of days, it doesn't really make a whole lot of sense to be fully invested. Especially, I would not be in any leverage on the long side based on what happened yesterday. Now, speaking of leverage, the IWM is an area that I am looking at leverage, but I'd like to see the 20-day test. I don't know if we're going to see that or not, but if we get to the 20-day, I'll probably have some of the TNA. I'll look at all the other signals I'm seeing, but I've been waiting for a 20-day test. So I think this is an opportunity, but could we pull back another 1.5% here? We're at 195.11. The 20-day is at 193.43. Literally, that's like 1%. So could we pull back 1% to the 20-day? Yeah, we might get it at the open. I haven't looked to see what the IWM's doing. Actually, we could do that. See what the IWM's doing pre-market. It actually isn't doing as badly as some of the others, unless everything's bounced back. Let's see what the Qs are doing. Yeah, Qs have come back some. Down, well, not a whole lot. 0.63, futures are 0.66. So looks like we've bounced back a little bit, but the IWM is hanging in a little better, and that's what we've been seeing. So if I'm aggressive anything, or if I'm starting to get aggressive anything, it's going to be the IWM. Transports, we're seeing a little pullback. Most of it's gap downs, though. I don't really see any big red candles. I mean, if you see any, let me know. But I mean, this is pretty much just gap downs. Yesterday, or the day before yesterday, we gapped down. We actually finished above the open. Did the same thing on the IWM, small caps. Yesterday, we saw selling intraday, most of it triggered at the open, but then some selling. A lot of it, we came back. We saw the market come back. Now, the increase in selling in that last 20, 30 minutes yesterday made me a little nervous about today's open, because we looked like we were going to be closing below some 20 days. And that just makes me nervous about things potentially accelerating to the downside. All right, let's talk about the chart of the day. So if you like the chart of the day, go over to earningsbeats.com. That's our home, earningsbeats.com, both plural. And go down and make sure you subscribe to our free EB Digest newsletter. It's released Mondays, Wednesdays, and Fridays. Try to get it out around 8:30 in the morning. Sometimes I'm not great about that, just other things going on. But that's what we strive for. Name and an email address, all it takes. It is a free newsletter, completely free, no credit card required. You don't have to pay anything at any point. You can unsubscribe at any time. So, and I try to provide a lot of education. So I don't know why you wouldn't want to be part of that. But if it's not your style, unsubscribe. Also, anyone who is a Earnings Beats Digest member can come to any of our free events. We'll send out room instructions to our entire Earnings Beats Digest community. So another reason to be part of that, so that you don't miss some of these educational events that we do for free from time to time. All right, let's take a look at the chart of the day. So I think the chart of the day is the VIX. And that was something that kind of got my attention yesterday. Again, I don't think we have any kind of a runaway VIX, but we have a breakout, and we need to recognize that. So if you're connecting kind of like these recent highs, you will see that the VIX since mid-March has been going down, and really the stock market, if you look at the S&P down here, it's been taking off since mid-March, going straight up, while the VIX has been going down. Perfect. As we kept going up here, though, we were struggling to get below the lows that we saw in June. So volatility was starting to kind of not really go opposite. And when we see that, I mean, if you look back here, this is a correlation between the VIX and the S&P 500. This was back at the beginning of the year. I talked about this, wrote an article over at Stock Charts, I think right on this date, like January 5th or January 6th, saying that basically a sentiment indicator is suggesting we're going to have a huge move to the upside. And the reason I said that was that if you notice, the market, or the VIX, was going down and the S&P was going down. The significance there is that normally when the S&P goes down, we get more fearful. And the VIX is based essentially on how market makers are pricing options. So market makers have a hand in this. When market makers are saying that we're going to price those options lower because we just think there's not going to be much volatility, they're essentially telling us that we're probably in a bull market. I mean, that's what happens in a bull market. The volatility shrinks and the market goes up. Well, one key thing that I found out through all my years of research, one thing looking at the VIX, is that if you go down and you look at the correlation, it spends almost all its time at -1, or usually below -0.75, telling you that there's a very strong inverse correlation, which is exactly what I would expect between the VIX and the S&P 500. But when you get positive correlation for a period of time, then the VIX is not exactly going along with, in other words, market makers are not necessarily agreeing with what's going on in the market. So the S&P was going down, and the VIX is kind of telling us that we really are pricing in kind of bull market activity. We're not fearful at all. And when we see that, whatever direction the S&P 500 is going in, normally based on the history, and I've gone back a long ways, normally we get a reversal in the S&P 500. And so that's why at the beginning of January, I said, we're ready to explode. And the S&P 500 had, I think, the 6th or 7th best January since 1950. All right, so now let's fast forward, because now we go up, VIX goes down, we go down, VIX goes up. And then just recently, we've kind of seen a little change, and you can see that here. The VIX was rising. The S&P 500 was rising. So we kind of got this trigger right here. Now, honestly, it didn't trigger immediately. I mean, it came in probably somewhere around when the S&P was 4,500, but we've been struggling since then. And now we're starting to see some technical signs, and we had the VIX breakout. I'm not going to ignore all of this. I will say that these are short-term issues. Short-term. This has nothing to do with whether we're in a long-term secular bull market or a longer-term secular bear market, for those who might think we're still there. This signal has nothing to do. This is a short-term signal. So what it's telling me, though, is that while we were going up, the VIX all along was basically saying, hey, you could reverse. Remember, we had the 5-day moving average of the put-call ratio, which hit the lowest level in a year, right at about that same time. So we had everybody getting much more bullish in the short term, very short term. I mean, if we look at the 1-year moving average of the equity put call, we're still way high, which supports long-term bull market. The 5-day moving average of the CPCE supports short-term pullback. The VIX, that correlation suggests short-term pullback. The negative divergences we've been talking about suggests short-term pullback. So you can't ignore, even no matter how bullish you are, and I'm pretty bullish, you can't ignore some of the short-term warning signs. And so I try to position my portfolio. I don't want to ride it back down. If this turns into a 4 or 5, 6%, type of correction or pullback, I don't want to just ride it back down and give away all my profits. So part of this is just recognizing the short-term risk and taking appropriate steps, whatever that means to each individual. Could mean completely different. You could be a long-term investor and say, I don't care about the short term. I'm going to stick. I don't want to miss out on the long term. I'm going to stick with the market even through short-term turbulence. That's what a lot of folks will say. They don't want to deal with it. They don't want to be out of the market one day and back in 2 days later. Well, I'm a little bit different. I watch the market every day. And if I think the market has the potential for selling off for a couple of days, I'm going to start moving to the sidelines. Or at least if I was in something like leverage, I'd move back, get out of leverage, and back in, instead of the TNA 3 times the IWM, I'd just take the money out of the TNA and I'd put it back in the IWM. I've said for the past couple of weeks, I don't think leverage is the way to go. I think if you're long and you're leveraged, you're taking on a lot of risk because of all the short-term things I'm talking about. All right, we got a couple minutes. I wanted to just show you our earnings, upcoming earnings from what's day, Thursday. So it's been Tuesday afternoon after the market closes. These are all companies that reported either Tuesday afternoon after the bell or Wednesday morning before the bell. And so yesterday was the reaction day. This is Wall Street reaction day to all of those earnings reports, which we have on one list, one chart list. And if you edit this, it'll tell you how many stocks are on here. 186. So 186 stocks, we can pull up at the opening bell and we can see what's going on, right? I mean, here it is. So now, of course, it's not 9:30. This is after a full day's trading, but you can see the companies that got the big moves to the upside. Elf Beauty, this has been one of the best stocks of 2023, maybe even going back a little before that. But this stock has absolutely been on fire. Another 14% move with its earnings yesterday. Very, very interesting. This type of stock that I would love to get on a pullback. There you can see that Scooter, 99.3. Vertiv Holdings. This is also in, this is in the technology area. Scooter, 99.5, up 29% yesterday. But what didn't work out so well? Go back and quickly look. Driven Brands, Scooter, 0.3. I don't know where the Scooter was before yesterday because it went down 41%. So it could have taken a huge dive with that earnings report. But if you notice, most of these companies, if you go down the list here, very few of these companies that took a hit yesterday have Scooters anywhere near the 90s. Here was one at 86. But you have to go way down the list. That was Multiplan Software Company that took a hit yesterday. Another way to look at this is you can sort it in Scooter order and then go to industry. And let's say, hey, I love software stocks. I want to find good, solid software stocks that are pulling back. In this case, because of earnings. And here they are, listed in order of their scooter. So Freshworks went up 18%. But you can see a number of these software stocks got hit pretty good. 23% on Meridian Link, Dynatrace 13%, Avid Exchange 11%, Multiplan, as I mentioned, 9%. Very few went up other than Freshworks. We did have almost a 10% gain in Aspen Technology. But there you go. Now the market just opened. It's 9:30. I'm going to pull up the next day's earnings. This is another day. This is another chart list. So this is everything that reported, every company that reported last night after the bell and this morning before the open. I'm going to pull this chart list up and let's see what's going on here. Well, Upwork up 36% at the open. I can tell you right now, I don't have to go through 100 or 200 charts. I can show you how many are on here in just a second, but I don't need to go pouring through 200 or 250 charts. I can just pull up one chart list and it'll tell me right away the best performers. And if you think something's overblown to the downside, look at what's getting hit first or the hardest. I mean, we've got energy recovery in the industrials. Then we got 3 technology stocks, including another software, Schrodinger, SDGR, down 21% in the first minute of trading. Going down, seeing if there's anything in here. Robinhood down 10%. That had started to perk back up again. You can see went down to under $11, already back to $11.50 in the first 2 minutes of trading. Anyhow, I think that chart list is really pretty cool. Being able to look at all of the earnings reactions in one chart list immediately. And you can look at it. You might say, well, I just want to know alphabetical order. I want to just go look for my stock, try and find my stock that I'm really interested in. You could do it by sector and just kind of take a quick look. I mean, this kind of gives you a feel for what we might expect today. Are the big sectors that are reporting earnings, the communication services, consumer discretionary, and technology? What's the initial reaction of the earnings in those areas? Here's communication services all together. One big one, other one's pretty flat. How about discretionary? Do we see a pattern in discretionary? Well, discretionary goes from here, let's see, all the way down to here. I see probably, it looks to me like just a mixture. I'm not really seeing like overwhelming number one direction or the other. And then we go down to technology, all the way down toward the bottom. And technology earnings are out. And here we got CSGS software up 26%. EVGO, renewable energy, that also is a heavily shorted stock, by the way, up 24%. That might be something that could really take off. I don't remember what the short percentage is, but I know it's either on our short squeeze chart list or it has recently been on there. Fastly, this stock's been doing pretty well, 12% today. Another software stock, but it probably didn't open with a breakout. So I think if it gets up over 19, I'd be a little careful. I'd take my money. Normally, if a stock's going to break out, and this isn't always, but if a stock is going to break out, a lot of times you'll see that open above any prior candle body. So when I see gap ups like this that are really nice, but we don't get the breakout, I start thinking short term, a little bit more bearish. So maybe we get up to 19 and some change, but I suspect we don't get this breakout today. All right, that's about it. What are we? We're 4 minutes in. Let's take a quick look at what's going on in the market. We are still seeing some selling. Looks like about 0.5% to maybe 0.6% seems to be the level of selling across most areas. The Dow is down just 0.2%. So we're seeing a little bit better action there on a relative basis. Small caps, though, did show a little bit. I've been looking at this early in the day, looking to see where the S&P small cap and mid cap index are relative to the Nasdaq, and then looking again at the end of the day. See if that money continues to rotate. So a little bit more weakness on the mid caps. Small caps and the Nasdaq right now are about neck and neck. So where do we finish? Are they going to be relatively flat, or is one group seeing more rotation than another. Couple interesting things about that before I let you go here. Number one, small caps have been showing that relative strength. So that would be something that maybe I would expect today, except at the end of the day, we got Apple and Amazon reporting. Will money rotate back into those areas, into those stocks before earnings? I didn't even look at Apple stock chart after yesterday. See, Apple is now down below its 20-day. You know, if it sells off and gets down to the 50-day, if it's a rough day today, I'd be tempted to take a little shot with Apple because I think Apple's going to have blowout numbers. I think Amazon is setting up for pretty good numbers. We're already at that 50-day. I mean, somebody who really likes to roll the dice could maybe take a shot going into earnings with Amazon. That's completely up to you. I don't know what I'm going to do. If I did anything with either of these companies into earnings, it would be a small position, not doing anything crazy. And that's about it for me today. So let's go ahead and wrap this thing up and let's just see what the market holds. Remember, VIX is a little higher. Maybe we take one final look, see where the VIX open. Yeah, VIX up over 17, setting a new high above the early July high. If the market continues to sell off near term, watch the VIX around 20. If we get up to 20 on the VIX, I will absolutely be having some money, significant amounts of money back in the market because I don't think it's going to close above 20. If it does and the market keeps going down, I'll simply take some small losses and just move back to the sidelines. But I've been waiting for a little bit of selling, so I'm kind of welcoming this selling. And again, checking on intermarket relationships, and we go from there. All right, everybody have a great day. Be back on Tuesday for the next Trading Places live show. Remember, non-farm payrolls out tomorrow morning, and of course, Apple and Amazon after the bell. Have a great day, everybody. Happy trading.